current market price for ASML shares implies an annual free cash flow growth rate of 21.8% over the next decade. This figure is central to understanding the expectations embedded in the share price. The key question for any observer is whether ASML can deliver on this implied growth rate. The market's valuation is not simply a reflection of past performance, but a projection of what investors collectively believe the company can achieve in the future. ASML is a supplier of lithography systems, which are essential tools in the semiconductor manufacturing process. The company's products play a critical role in enabling the production of advanced microchips. This context is important, as it frames the type of growth and operational performance that the market is currently pricing in. As of July 15, 2026, ASML is listed on the ASML.AS exchange. The share price stands at 1,555 a year, with a total market capitalization of 599,632,138,656 €. The trailing 4 quarters of free cash flow, covering the period from June 30, 2025 to March 31, 2026, amount to 8,933,400,000 €. All figures are reported in euros, which is significant for consistency in valuation and comparison. The trailing 12-month period provides a recent snapshot of the company's cash-generating ability, forming the baseline for forward-looking models. A reverse discounted cash flow, DCF analysis, works by starting with the current share price and working backwards to determine what future cash flow growth rates are implied by that price. Instead of forecasting cash flows and discounting them to arrive at a price, the reverse DCF takes the observed price as given and solves for the growth rate that would justify it, given a set of assumptions. In this case, the model uses a discount rate of 9.0%. This rate reflects the required return for investors, accounting for the time value of money and risk. The explicit forecast period is 10 years, meaning the model projects free cash flows over the next decade. After this period, a terminal growth rate of 2.5% is applied, representing the assumed perpetual growth of cash flows beyond the forecast horizon. The reverse DCF model, using these inputs, finds that the current share price implies that ASML's free cash flow will need to grow at an average annual rate of 21.8% for the next 10 years. This is compared with ASML's historical free cash flow CAGR of 15.4% from 2022 through 2025. The implied rate is 6.3 percentage points higher than that historical benchmark, which the model describes as demanding. This gap highlights the level of optimism embedded in the current valuation. The historical benchmark is calculated from ASML's annual free cash flow figures supplied by the same data source. Free cash flow was about 7.17 billion euros in 2022, fell to 3.25 billion in 2023, recovered to 9.08 billion in 2024, and reached 11.3 billion in 2025. The compounded growth rate from the 2022 endpoint to the 2025 endpoint is 15.4% per year. This KGR is not a simple average of the year-over-year changes, and the annual chart makes the volatility clear. The market-implied 21.8% is therefore 6.3 percentage points above ASML's recent historical endpoint trend. Sensitivity to the discount rate is an important aspect of any DCF model. At an 8.0% discount rate, the reverse DCF implies 19.0% annual free cash flow growth. At the 9% base rate, it implies 21.8%. At a 10.0% discount rate, the required growth rises to 24.3%. Moving from 8.0% to 10.0% therefore changes the implied growth requirement by about 5.2 percentage points. A higher required return reduces the present value of future cash flows, so more growth is needed to support the same market price. For the current price to be justified, several things must go right for ASML. The company must sustain a pace of free cash flow growth averaging 21.8% annually for a full decade. This requires not only maintaining but accelerating its ability to generate cash from operations. The implied growth rate suggests that the market expects ASML to continue playing a pivotal role in semiconductor manufacturing, with its lithography systems remaining essential to chip production. The company would need to successfully execute on its business strategy, maintain or expand its market position, and possibly benefit from ongoing demand for advanced semiconductor manufacturing equipment. Operational efficiency, technological leadership, and the ability to convert revenue into free cash flow at a high rate would all be necessary. The company would also need to navigate industry cycles, competitive pressures, and any potential disruptions without significant setbacks to its cash flow trajectory. However, there are also risks that could prevent these expectations from being met. If ASML's free cash flow growth were to fall short of the implied 21.8% annual rate, the current share price would not be supported by the company's actual performance. Model risks include the possibility that the discount rate does not accurately reflect the true risk profile, or that the terminal growth rate is overly optimistic. If the discount rate were to rise due to changes in market conditions or perceived risk, the required growth rate would increase further, making the current price harder to justify. Similarly, if the terminal growth rate were to be revised downward, the implied growth requirement for the explicit forecast period would rise. Any operational challenges, changes in industry dynamics, or shifts in demand for lithography systems could also impact the company's ability to deliver the required cash flow growth. The model does not account for unforeseen events or structural changes in the industry that could affect long-term performance. In summary, the reverse DCF analysis shows that ASML's current share price implies a demanding free cash flow growth rate of 21.8% per year over the next decade, which is 6.3 percentage points above the 15.4% historical FCF CAGR. This sets a high bar for future performance and reflects significant optimism about the company's prospects. The analysis is sensitive to the chosen discount and terminal growth rates, and the historical benchmark itself covers a short and volatile period. The reverse DCF framework is a tool for understanding what the market price implies, not a recommendation or prediction. It highlights the expectations embedded in the current valuation and provides a basis for further analysis, but it does not constitute investment advice.